something like 250 hedge fund managers all have substantial positions in Apple. I think this is like a question of, not a lot has been working, and so everyone's sort of desperately running towards the one thing that seems to be the consensus view. But I tell you one thing, Phil, something we've learned over the years is that anytime you get a consensus in agreement about something going in only one direction, you find that that's exactly when it turns on them.
It's been a pretty good week for stocks overall, the bull market entering its fourth year. Now, who are these analysts and experts who are saying the market's being driven by fundamentals and that stocks are heading higher?
Well, you really do have to break things down into a lot of constituent elements there, because if you look, for example, at the TSX, it actually is back at the level, it's something like 10% below where it was this time last year. So it's not fair to say that everything's making new highs. The S&P certainly has made a new high, and you have some leaders there, for example, in the banking sector the last few months, which goes back to, how much assistance the banking sector's received, the unprecedented intervention. They've been backed by the Federal Reserves all over the world, and they were doubling down on their proprietary trading, and it's really evolved into this risk-on trader mentality at all the investment banks. So now you have, for example, the news this week, Phil, where J.P. Morgan jumps ahead of the queue and leaks a report to the market saying, hey, we passed the stress test. This whole new round of rigged stress tests, which are all designed for the majority of the banks to pass them, right, so that it restores confidence. So you've seen some momentum to the upside, pushing the overall index in the U.S., for example, higher this week. But I think that the mixed currents there are quite remarkable. At the same time, you have things like the China slowdown story really starting to take some traction. You have things like the Euro story continuing to bubble behind the scenes, right? So you have things like Greek bonds that remember last week, Phil, all the hullabaloo about this, who was taking up this new issue of bonds and the big haircut. Well, the next day those bonds traded for 18 cents on the dollar. So it's absolutely not fixed anything. It's absolute nonsense. And so you get this sort of Laurel and Hardy show each day, and people call that sort of intelligent assessment. But really, you've got a bunch of other governments now, like Ireland, who has stated outright, we now wish to go back and renegotiate. We want a haircut on our bonds too, which makes perfect sense. And you've got Spain missing their budget restraint targets by a huge margin, and basically saying, sorry, too bad, we're not even going to try and cut more right now, as their housing market has finally started to fall, Phil. This is an interesting story we've been watching. The Spanish housing market continued on up after many other parts of the world had already began to decline, and now we're seeing that in many parts of the country, property values are dropping anywhere from 20 to 50%. So there's a lot of, headline stories like, hey, the banks get to pay dividends, which, by the way, we don't want them to do because they still don't have sufficient capital, and they're still taking big risks, and they've still got the taxpayer on the hook if they blow up at this point. So we really don't want them depleting their capital, but you get a story like that moving the market, and you get Apple at euphoric highs and everything else kind of quietly crumbling in the background.
Another index we watch out of the corner of one eye, the VIX, hitting its lowest level since 2007 this week as well, Danielle.
There is the exact, that's the quintessential poster child for the complacency in one part of the population or segment in these markets, and the reality-based assessments by some of us. For example, the VIX. So you see that it really just plummeted more than 30% in the last couple of weeks as this whole belief that, number one, Europe had patched itself, and number two, that the banks in the U.S. had passed this stress test. So you had a lot of anticipation this week about whether the Fed was going to tip its hat, and Bill Gross tweeted, this is the world we're in, Bill Gross tweets this week, hey, expect them to say something about more QE at the April meeting. And you see stocks surge like 1.3% in a matter of the last hour. So you get that kind of euphoria, and the VIX crumbles because everyone says, wow, if they're going to intervene again, they're going to prop markets up more, then there won't be any downside risk for a while here. But the sad reality of that is, Phil, that when the VIX is low, that's actually the greatest risk because that dictates complacency in widespread use. So that's an example of the last time the VIX was at current levels, below 16, was just before the mess hit in 2007. So mid-2007, you had a VIX fall to 16. Now we're back there again, which is not a very calming idea for anyone that knows how to read this stuff.
Danielle Park is our guest on This Week in Money, and the Fed, of course, got together this week. What was the big deal? They basically announced nothing, saying they're going to keep rates low at least through late 2014.
Yeah, so this goes back to something I think we were talking about a few weeks ago, Phil, which is, again, I like to look at what are the prima facie main consensus view coming into 2012. Well, I think they are as follows. There's a widespread belief that central bankers will print, and not slow pumping liquidity into the global banking system. That's why I think you see this plummet in the VIX indicator, right? A belief that central bankers will be able to somehow hold off the gravity or the reality of stock prices, make them stay where they are rather than revert more to their long-term average. And then also there's a belief that they will continue to print. So you had things like gold, right, going through the roof in the last number of years, and certainly having a good rally again in the last few months. And then all of a sudden they come out and say, well, the economy might be doing better, so we don't know if we can basically justify more QE, do more intervention. And so what if, coming into the 12, what if that belief that there's an endless amount of printing is not the case? What if the political pressure, because all these governments are switching in the next 12 months, all over the world you're having elections everywhere and people getting thrown out. Sarkozy looks like he's not going to get back in. You've got Chinese big political turnover there. You've got the U.S. elections. What if they don't actually intervene much in 2012? That would be a big shock to this market that's so complacent and addicted, really, to free money. So I think that might be a major theme. And also, as I say, another one of the consensus views has been that China will grow no matter what, because they're centrally planned and they will pump money, and they've got this $3 trillion, this $3 trillion of reserves, and all that. But actually, they're saying now, listen, we've got a huge problem. We have a huge overbuild and overdependency on the property sector. We've got a massive bubble. We have to allow this thing to cool down. And so they're not stepping up either towards more stimulus at this particular time. So I think that the disappointment could be that nobody does anything big for a while here. And then you've got just the stock market, on this wild ride, suddenly trying to relate to where is growth really at. The Chinese slowdown story is likely to hit commodity-centric countries like Canada and Australia. Our currency's been overvalued again on this belief that exports to China will never slow down. Well, they are. And we're seeing it already, Phil. It's not a future story. It's right now. Cement and steel and a lot of the components that the Chinese have been voraciously gobbling up to overbuild their infrastructure the last number of years are now plummeting in terms of they're not buying the stuff. And so I think that could be another big surprise going into 2012, that China actually has a significant slowdown, that central bankers don't continue to just print right now, with all the political pressures, and that there won't be any real backdrop to counter this slowing growth story, in which case you could see a lot more volatility come back into markets. Even bonds, Phil. Okay, so bonds in the last couple of weeks have sold off. Again, I think part and parcel with this belief that, coincident indicators in the economy are maybe looking a little firmer to some people, and the Fed said, listen, guys, we don't need to do more QE right now. Things seem to be tentatively improving. So you've kind of got that belief system going on. And I think that that's where you see capital coming out of bonds again, maybe, out of the safe haven idea, pulling out of gold, pulling out of bonds. But if we get into this next phase, which I believe will be a surprise to the downside on the growth story, I think that this might prove to be a buying opportunity again, certainly for bonds. Now, for gold, I'm not so sure. At this point, we're kind of in the middle. We're kind of in the, it hasn't broke 1550 and it hasn't broke out to a new high. So you may see that if the fear trade comes back, people repatriate money back to what they consider to be a safe haven there. However, at the same time, you'll have delevering going on. So it's a question of, will there be more buyers than sellers? And right now, it's really difficult to tell.
We're talking to Danielle Park on This Week in Money. Lots of cheery talk this week about the U.S. economy, Danielle. On the road to recovery, unemployment claims falling last week, another 15,000. But you're looking at some new information from the ECRI folks. What do they do, and what does the report tell us?
Well, they have this, 40-year track record of using these basic a composite of indicators that they're, very objective in taking measurements, as objective as humans can be, I guess, in taking measurements of the economy, which is a little bit imprecise and retrospective. But they've had a very good track record of calling downturns recessions, and they've been saying for the last, many months that there's a U.S. recession coming in 2012 based on their leading indicators. So I think one of the big things, and they explain it in the report that they released today, I put a link on the blog, is that the seasonality aspect, warm weather, warmer winter than normal, Phil, in a lot of the north this year, has really skewed some of the data, both in terms of employment and certain sectors that have done more hiring as a result earlier. And also they explain in that piece about the how the indicators responded in the 08-09 downturn, how they basically went off their normal trajectory because that recession was so deep relative to recent history. And as a result, the bounce back in some of those indicators was a little misleading. So they're saying they think that even some of the positive stuff lately is going to be corrected in retrospect down the road, and that we will see that it was really giving a false positive in terms of momentum and growth in the economy. So their chart is quite obvious.
Okay.
They show it, and I put it on the blog. It's just saying, guys, listen, we're not making this stuff up. I know you don't want to hear it, but here's the picture. Every time the leading indicator composite has fallen in the way that it has, we've been about to or already entered into a U.S. recession. And we know we're in recession in Japan and the Eurozone and the UK. So really, if China's weakening, as all indicators suggest it is, where exactly do we expect this growth to come from in the next year or so?
Danielle, one of the fun stories this week, people story, Goldman Sachs exec Greg Smith quits this week in the New York Times and says Goldman is toxic.
Yeah, he found religion, Phil.
Yeah.
Good for him. I say better late than never, Listen, I spent the first few years of my career in the Southside Institution, and I would have to corroborate everything that he indicated there. It's a hell of a culture. And there's some people that would say, listen, it's capitalism, and of course they're there to sell a product and make a profit. And I agree with all that. That's wonderful. But here's the problem. In the last 15 years in particular, the banking sector has migrated from we're a product sales company to we're your trusted advisor mantra, right? So they've sold and packaged themselves as no longer, sharks you should wear shark repellent and be careful with, to don't worry, trust us, we'll lead you where you need to go, we'll help you become rich. For countries, we'll restructure your debt, we'll help you get into the EU, we'll help companies, be taken public, so we'll reconfigure all your balance sheets, we'll put a bunch of stuff off book, we'll help you figure out how to dupe the investment public, and then we'll start dealing with you and taking advantage of you as our client. Now that we've convinced you to trust us and we're the smartest guys in the room and all that, now we're also going to do back deals and stab you when you're not looking. So at some point it becomes this cesspool, and this goes back to why Paul Volcker, the Volcker rule, or why we had Glass-Steagall in the first place, because it's very common in history that this is the trajectory that financial institutions take. They were divided, 60 years ago for exactly these reasons. They needed to be broken down into constituents. And if Goldman Sachs wants to be the shark on leverage who's trading, and taking big bets and making big bucks, fantastic, but do it on your own time. Do it on your own buck. Don't have any expectation of bailout from the taxpayer. Don't, parade yourself as this trusted advisor.